My name is Peter Till. I'm the chairman of the advisory board of the Energy and Environment Alliance, and I'd like to welcome you all here. It's great to see so many people joining us today on this, what we think is an important issue. The EEA was established last year as a nonprofit organization to help our industry achieve a carbon neutral footprint. But I think, as we'll all see later on, our industry is struggling to move towards that objective due to the fractured nature of our business and the requirements of other more immediate concerns like profit. We are lagging behind other industries.
Hello.
And the need to make progress is growing daily as pressure is increasing from all directions, including investors, as we will hear today. And what the hotel industry needs, in our view, is a robust, data-based, centralized source for best practices, standardized metrics, and benchmarking. And that is the gap that the EEA is designed to fill. Today's event focuses on the investor perspective on this issue. And I think we have an excellent panel to lead our discussions. On the panel, starting off, is Ed Birkin. Ed is the director of Ignite Economics, and he is also the EEA's economics advisor. After Ed is Julia Kochetagova. She is the head of stewardship at Northern Trust and a member of the Climate Action 100+. After Julia, we have David Stevens, who is the head of real estate finance at HSBC. He was formerly the head of the hotel division there. And then we have Sir David Michels, the chairman of Michels and Taylor. And of course, he was formerly chief executive of the Hilton Group, amongst many other things. So why don't we just go ahead and get started, and I'll call upon Ed to begin his presentation. Thanks, Ed.
Thank you, Peter. I will try and be brief because I'm aware that there's a reason economics presentations are normally in the morning. So if I can share my screen, we'll go straight to the presentation. What I'm trying to do is run through some research that we did at Ignite Economics, looking at the energy usage in the UK and in particular the hospitality industry, just to try and frame what we're doing with the EEA. So the four key takeaways from this is that the UK has seen a sustained decline in energy usage over the past 20 years. And it has actually seen an even steeper decline in energy intensity. Now, this is the amount of energy used to create 1 unit of economic output. The proportion of renewable energy has increased over time, which means there's an even greater drop in the use of fossil fuels. However, the accommodation sector has seen an increase in energy usage, an increase in energy intensity, and an increase in fossil fuel usage over the same period. Now, it's clear that the accommodations and sector isn't one of the big users of energy. And actually, when you add it with food services, it represents less than 2% of the UK's energy usage. However, if you exclude the household consumer expenditure, it is the 7th largest consumer of energy, and behind the big ones you'd think, such as transport, manufacturing, mining. So if you then flip it around and put it in the context of being a services industry, it is by far and away the largest consumer of energy of any of the services industries. Now, if you look at the change in energy usage over time since the year 2000, we can see that almost every sector has seen a decline in energy usage since the turn of the century. The biggest user of energy, the manufacturing sector, has reduced its energy consumption by almost 40% over this period. But the accommodation sector is the big outlier, and that's seen its energy increase by 47%, while that of the overall economy has fallen by 20%. And this has actually led to a doubling of the proportion of the total UK energy usage that the hotel sector represents since 2000. Now, clearly, what this doesn't do is take into account the relative underlying growth of each sector, and it wouldn't be fair to compare a growth industry such as ours to the manufacturing sector. And over this period, hotel room numbers in the UK have increased by roughly 70%. So on a per room basis, the energy usage of the accommodation sector has declined at roughly the same rate as that of the overall economy. Now, while this suggests the increase in energy use is just due to the underlying growth of the industry, this also doesn't take into account the overall growth of the economy over this period. And on that basis, the accommodation sector has significantly underperformed other industries in terms of energy usage. And that's why it's important to look at energy intensity, which is the second point I made. So energy intensity measures the amount of energy used to create 1 unit of economic output. In this case, it happens to be terajoules of energy to create £1 million of value add to the economy. Now, clearly different industries have different energy needs, just as different labour intensity. So the important thing is to measure the change in energy intensity rather than the actual energy intensity of each industry. And the UK has reduced its energy intensity by 53% since 1990, or in other words, it takes 53% less energy today to produce the same amount of economic output than it did in 1990.
On silent.
I think we've lost Ed there, Peter. So I don't know if you would maybe like to move on.
Okay, do we have a way to unshare his screen? Oh, there we go. You've done it.
That's one way of keeping the presentation short, isn't it?
A bit heavy-handed, but it works. I think we might pick up on more of Ed's presentation later on if he gets back online. But in the meantime, we will turn to Julia, please.
Okay, thank you, Peter. So yeah, I'll share my screen then. Can you see it?
Yes.
Yes. Okay. Okay. So as Peter said in the beginning, I'm responsible for stewardship in EMEA at Northern Trust Asset Management. I have been in this role for almost 2 years, and before that, also with Northern Trust Asset Management, I was responsible for designing new ESG products, index products, and quant products primarily. Just a few words about Northern Trust, what it is. It's one of the largest asset managers in the world with $1.1 trillion under management at the moment. And I think that what we are particularly good at, and something that I was involved in my previous role at the company, is sustainable investing. We have $106 billion invested in various sustainable investing strategies. And one of those strategies is actually a strategy for the real estate sector in developed countries. It is based on the data from GRESB. So it's an index which selects companies on the basis of the GRESB assessment, whether companies do have the GRESB assessment and how high it is. And those with low scores or no scores are not selected. So something for you to bear in mind. My topic today is about collaborative engagements. But before we go to discuss collaborative engagements, I just wanted to say a couple of words about what it is. What is responsible stewardship that I'm responsible for at Northern Trust Asset Management? Investor stewardship involves 2 things. One is engaging with companies, talking to companies about their sustainability issues and trying to drive sustainable change by talking to them. And the second one is proxy voting. So proxy voting, if you think about it, is kind of a last resort. When you are not successful with engagements and the company is not making sustainable change, then you will vote against management at the shareholder meetings. So the way we do it, we firstly look at what topics we want to focus on. And clearly climate change, decarbonization, low carbon energy transition has been on our radar screen for all the period of existence of responsible stewardship. Once we prioritize, we often write guidances on what we want to see at companies. And you can see here on this slide on the right-hand side, an example of such guidance related to climate disclosures, TCFD disclosures, and another one related to thermal coal, but particularly for electricity generation companies, that companies can refer to understand what we're trying to achieve when we engage with them. And then when we talk to companies, we want to see progress. We measure progress by a system of milestones. And when it comes to the voting season, we actually evaluate how much progress we have achieved. And then we decide, okay, this is a company that has progressed well. We're going to support management. This is a company that has not had not progressed well. We will firstly support a shareholder resolution if there is one, and secondly vote against management on certain issues, primarily the issues of director elections. So we have voted again against many directors just on the grounds of the failure to achieve sustainable progress with regard to environmental and social.
280.
Hello? Someone is talking. Can you put yourself on mute, please, or say something if you want to say? Okay, so collaborative engagements. This is the major topic that I wanted to discuss with you today. When investors get together, the power is in numbers. When you have many investors representing the same idea, sharing the same objectives, then definitely this is going to make investor engagements more effective and more efficient as well, because we speak in one voice. The company has a chance to just speak once instead of speaking with many different investors at many different times. Climate Action 100+ is an example of one such initiative. It was established in December 2017, soon after the Paris Agreement was signed, for the period of 5 years, with the goal of driving change at high carbon companies, at those companies who are in the most carbon intensive sectors, to make them commit to net zero by 2050 and develop clear transition plans. The current representation of this association, well, it's not an association strictly speaking, it's an initiative. The current representation is 545 investors, $52 trillion of assets represented by those investors. And the focus companies are those from, as I said, the most high carbon sectors, such as oil and gas, electricity production, transportation, automobile construction, and there are 167 such companies. There aren't any companies from the real estate sector yet. The reason why is just, it had to be a relatively limited number for investors to be able to really focus on these companies. But there is nothing to suggest that real estate sector or accommodation sector will not be selected going forward, even when the decision is being made to expand the number of companies. So this is something that I want to draw your attention to, because now we speak with the Glencores and the Michels of this world, but it may change. It may be an expanded number, expanded focus going forward. So Climate Action publishes reports every year on the progress that was made with engagements. Oops, can you hear me well?
Yes, Julia.
Okay. The most recent report was just recently published, and I should say 2020 was a very successful year, despite all the disasters that challenged the world in terms of the low carbon transition, or at least declarations and commitments that were adopted. It was a very successful year. Basically, all European companies, oil and gas companies in this or that form have adopted net zero commitments and have started elaborating on the details on how they're going to achieve this. This is already very, very important. So the way this initiative operates is there are investor groups focusing on each company. An investor group can be anything from 3 to 15 investors, depending on how high profile the company is and how many investors hold it in their portfolios. We at Northern Trust Asset Management are co-leads of 3 such groups. Of course, there has to be someone who will lead the initiative, arrange for the discussion with companies, set the agenda, discuss it on a preliminary basis with other investors. So we co-lead on 3 companies, Valero Energy in the US, Glencore and National Grid in Europe. And we were also members of 12 other company groups in Climate Action. So one thing that I wanted to highlight today is a very, very important development that is basically happening as we speak. This is called net zero benchmark. So net zero benchmark is a set of indicators and the assessment methodology that investors within climate action and the partnering research houses such as Transition Pathway Initiative have developed together to assess companies' progress. We need to see how, let's say, Shell is doing against Exxon and vice versa. So we need this robust and standardized framework for assessment of climate transition plans and the progress against those plans. The idea is that this framework is also going to be used in the so-called Say on Climate campaign. I'm sure you have heard this term already. It's kind of a parallel with Say on Pay, but something that is happening today, where Climate Action 100 Plus is trying to encourage companies to adopt transition plans, make them transparent, put them on vote at shareholder meetings at least every 3 years or whenever the plan changes, and then on an annual basis put the report on this plan, how the plan is being implemented, on the shareholder vote as well. Both votes are going to be non-binding and advisory. And what we mean by voting on transition plans or reviewing transition plans is this set of indicators that you see here in front of you. Whether or not the company has the net zero ambition, whether or not it has adopted very clear targets and goals. It's basically a combination of 3 indicators because it looks at long-term targets and goals, mid-term by 2030 or 2035, and something short-term as well. So something that management can be accountable for today to move towards this net zero goal at the end by 2050 or earlier. Whether or not there is a business strategy that clearly incorporates these goals, which is a combination of business goals and climate-related goals. How a company's CapEx plan is structured against this strategy, against this transition plan. Then another important element is the policy support, because sometimes companies say, yes, we are aligned with the goals of the Paris Agreement, but then behind the scenes, they're members, well, not behind the scenes, they're members of some industry associations. And kind of behind the scenes, what happens is that these industry associations engage with governments on their behalf, while the tone and the purpose of that engagement can be completely contradictory to the company's own goals and ambitions. So this has to be transparent. If you are members of certain industry associations, you have to investigate, you have to look into what these associations are doing in terms of climate policy lobbying. Then governance structure, whether or not the board of directors is clearly focused on checking against the greenhouse gas emissions targets and goals, the energy consumption, and all these relevant parts of the plan. Just transition is something that speaks about communities and about employees who may be laid off during the transition if they're no longer needed in the low carbon economy. It's probably less the case for the real estate sector or accommodation sector, but it's very much the case for mining sector or energy utilities. And finally, reporting. TCFD reporting, I'm sure that you're all familiar with this abbreviation, the Task Force on Climate-Related Financial Disclosure, and recommendations that they adopted 2.5 years ago. If you look at the real estate sector, for example, the level of disclosures is quite low. And we know that from GRESB because they are experiencing difficulties collecting the data through reports and questionnaires that they send to real estate companies, even though the situation is improving year on year, but it's still far from being perfect. And also, if you look at the FTSE EPRA Nareit Index, you will see that 65% of companies who are members of that index have very poor or no climate reporting at all. So sorry for taking your time. Just a couple of thoughts at the end as a conclusion to that. So net zero benchmark of Climate Action 100 Plus, this engagement initiative, is rapidly evolving as kind of a gold standard of how we should be discussing the low carbon transition at company level, how we should be assessing it, and also the framework for engagement between investors and companies. So take this into account, take this on board, look at all these elements. They're all publicly available on the website of Climate Action 100+, and see how you can assess your performance along these indicators and how you can build up your narrative. This is what best practice is going to be looking like in terms of the low carbon transition, the reporting, and also adopting the plans and putting them on shareholder vote. Bear in mind that even though real estate and hospitality sectors are not part of Climate Action 100+ at the moment, they can be added at some point. Banks, for example, are already considered as an addition to the group of companies that Climate Action 100+ is looking at. And then, you know, the pressure from investors and NGOs to put climate transition plans on vote is going to be only getting tougher. So think about this, putting climate transition plans on vote on a voluntary basis is much better than facing shareholder resolutions asking to do that. Okay? And you know, it may become mandatory in the UK in any case, like TCFD reporting will be by 2025. So it's better to prove your leadership by putting your climate transition plan on vote before it becomes mandatory or becomes demanded by investors. That's it from me.
Excellent, Julia. Thank you very much. That was fascinating and a real insight into what is being done in other energy-intensive industries. That's great. If we can now bounce back to our long-lost Ed. I understand he's back online and is in position to recommence his presentation. Nice to see you again, Ed.
Thanks, Peter. Apologies for that. Given the break, I'll try and wrap it up quicker than before. And I'm not sure where I lost you all, but I'm assuming it was on this slide. So just to quickly finish this, the accommodation services is one of only 3 industries to have an increased energy intensity since 1990, i.e. they all use more energy now to create the same level of economic output. That's along with mining and quarrying and construction. So not the best companies keep in that respect. We are looking at fossil fuel usage and how that's declined over time for the overall economy, but less so for the accommodation and food services. The conclusion of these 2 slides was just that the accommodation sector has seen an estimated increase in fossil fuel usage of 340,000 tonnes of oil equivalent per year compared to 1990. And that compares to a decline of 45 million tonnes of oil equivalent for the UK overall. So moving away from the statistics, why does this matter to hoteliers and their investors? Well, as we've heard from Julia, there's been a clear shift in investment towards ESG funds, and not being seen as environmentally responsible reduces your potential investor base substantially, maybe less so at the moment, but going forward, it's one-way traffic. The financial implications are significant. We estimate the cost of energy waste in the sector in the UK is equivalent to £270 million per year, and 660,000 tonnes per year of CO2. Working with our partners, we believe there can be energy savings of between 14 and 20%, which would lead to a cost saving of around £300 per room per annum. And for a large hotel, this could be a cost saving of around £70,000 or equate to a low to mid-single digit percentage uplift in overall hotel profitability. Now, what are the headwinds? We know there's no quick fix to this, and the industry has not made a conscious choice to increase energy usage. And we're very conscious of structural headwinds to the reduction of energy usage in the sector. For one, the industry is very fragmented, and the property owners and hotel operators are not necessarily the same people. Secondly, energy costs form a very small part of the cost base. When you've got other significant cost headwinds like increasing national living wage, food inflation, energy is not seen as an area of importance. And also many areas of energy intensity improvements need capital investment, and it's not exactly viewed as necessary capex, especially in a particular environment where keeping the lights on, for want of a better word, is seen as more important. There's also the issue the hotel industry doesn't see itself as a polluting industry, and that is very true. It's not like the mining or manufacturing industries, but in the context of a service industry, it is by far the highest energy usage. And finally, is there any consumer pressure? Do enough potential customers care about this to vote with their feet at the moment? So based on the above, what does the EEA do? One of the things we're trying to do, we will be doing, we're in the process of doing, is compiling an industry-leading benchmark that allows hotels to compare their energy usage and cost against their peers. So you can see if you are in fact using energy efficiently and what savings could be made. Secondly, not all carbon reduction has a cost. The EEA enables member companies to purchase their energy 100% sustainably, and often at a lower price that is available for most hoteliers. And then thirdly, if hoteliers do decide it's beneficial to their business to invest in energy efficiency, the EEA's partners can help members drive energy productivity levels in a highly cost-effective manner, with discounts on energy consultancy and energy monitoring technology. So I apologise, I was going to keep it brief. I may have been a bit liberal with the truth there, but just the final takeaways. The UK economy has seen a sustained fall in energy of 20% since 2000, but the accommodation sector has seen its energy increase by 47% over the same period. And that's not just due to the growth of the sector, but through worsening energy intensity. There's a clear shift in focus from both investors and consumers towards ESG. The EEA is building an industry-leading benchmark tool that will allow hoteliers to compare their performance to peers. Not all carbon reduction has a cost, and purchasing energy 100% sustainably, often at a lower price, is something that EEA members will be able to do. And there is a cost to the industry of energy waste. Even though it may be a relatively small part of overall hotel costs, energy waste is estimated to be circa £270 million per annum in the UK. Thank you very much for listening to part B, and back to you, Peter.
Great. Thanks, Ed. That's very good review. And we can see where we stand and what the challenges are. It's now time to turn to David Stevens, if he's there, for his presentation. Hi, David. Thank you.
Hi, thank you. Well, I don't have slides myself, so you've just got me on screen, but hopefully that means less technology to go wrong. First of all, thank you to Ufi and the team at InterAxs for inviting me along to speak today on this important topic. As per the introduction, I'm one of the senior bankers in HSBC's real estate finance team. I was head of the hotel sector team between June 2016 and August 18, and I now run the London corporate real estate finance team. I've been invited along today to specifically talk about what we're doing at HSBC with a focus on green financing. I'm going to start by acknowledging that clearly right now sustainability isn't going to be the #1 priority for the hotel sector as it tackles the issues of trading through the impact of lockdown, social distancing restrictions, and hopefully reopening in the very near future. This has obviously left a lot of hotel operators very focused on costs. However, I think there are a number of initiatives that the EEA are working on that are relevant and might assist operators with these costs whilst moving towards a more sustainable operating hotel. I picked up on a comment earlier about where the hotel industry is relative to some other sectors, and I think we need to avoid sort of beating ourselves up a little bit here, because actually this is something that I think we're really right at the very beginning of a journey in terms of transition to net zero. But it is a very, very important topic. And whilst the current position is acknowledged with regards to lockdown and focus on costs, etc., the issue of transition isn't going to be going away. So I always welcome the opportunity to speak with clients and others within the industry around what HSBC is doing to support operators as they move towards transitioning to a net zero environment. So if I just start by setting the scene, ESG is rapidly becoming one of the most important topics and rising change on the real estate agenda. And the pandemic has only serve to accelerate the trends that were already underway. Around 40% of energy emissions are attributed to the construction and operation of real estate. And as such, we can expect to see greater focus on our industry from a regulatory and investor perspective. And this has already begun, and Julia's already pointed out some of these points. There is increased focus from all stakeholders. If we look at the investors, there is mounting pressure on how institutional capital is deployed on sustainable investments. And again, Julia has outlined some of the points there in her presentation. There is focus on portfolio obsolescence and a growing awareness of what transition risk actually means. In a recent presentation by Knight Frank, it was estimated that 40% of capital will now be chasing assets aligned to investors' ESG requirements. And ESG is starting to feed into liquidity and pricing. CBRE have referenced that purchasers are now seeking sustainability reports as part of their M&A due diligence to understand the future cost of transition risk and seek to negotiate a price to reflect these costs. From a regulatory perspective, again, Julia has already mentioned growing focus on corporate reporting and matters such as TCFD. And there's also a growing focus on energy efficiency standards, with the minimum rating due to potentially increase from E to B by 2030. And lastly, we are starting to see some evidence of sustainability and well-being feed into clients and customers. And there is a small but growing number of brands in the hotel sector that are aligned to sustainability. So if we return to what this means to the banking industry, HSBC is very much focused on supporting our clients with transitioning to net zero. We announced last year our plan for the planet, where we have a stated aim to provide between $750 billion and $1 trillion in financing and investment over the next 10 years to help our clients achieve this. This is already well underway. We've provided a number of green loans to assist clients with development of new buildings that are being developed to sustainability accreditation standards such as BREEAM. If I'm honest, and I wouldn't say this to my bosses, actually doing new buildings is relatively easy from a sustainability perspective, because as part of the planning process, there's often a accreditation standard that is attached to that planning, which means that the building needs to be delivered to that standard, and we can map our financing to that. A great example of that is the development of the Londoner Hotel in Leicester Square, where HSBC provided development financing to the Edwardian Group to complete the development of this hotel to exceed BREEAM excellent standards. There are also a number of other development projects that we've got ongoing within our pipeline at the moment. However, funding of new buildings will only take us so far, and as I'm sure you're aware, there's only a certain number of new buildings that go up each year. Around 2/3 of the buildings that exist today will still be in place by 2050. And therefore, we need to be focusing on retrofitting of existing buildings to improve energy efficiency of these buildings and help reduce emission levels from those buildings. I know that this is something that the EA are very focused on, and I know that there is a partnership with BREE, which is one of the leading industry standards, and will help you assess the requirements in terms of what efficiencies can be deployed in your buildings to improve the sustainability of those buildings. This is something that all of our relationship directors are now focused on, and we're engaging with our clients to understand what transition means and what transition risk means for their business. Understanding transition risk is becoming a key focus for the banking industry as we become under growing pressure from our regulators on how we're managing climate-related risk in our books. And therefore, by having the right conversations with our clients, we can understand their business better, identify transition risks and how these can be potentially mitigated and funding through sustainable finance. So as I opened, thank you very much for inviting me along today. It's great to have the opportunity to speak to this audience and connect with a few other people and explain what we're doing from the banking perspective.
Thank you, David. That was very good, and nice to hear that you are also focused on lending to ESG projects. I think we share yours, we share your concern about existing buildings rather than new builds. There is a real challenge there. Now we can turn to Sir David Michels and get a bit of a different perspective if we can. Thanks, David.
Good afternoon, everybody. Because what I'm going to talk about is going to be called challenging at least, I need you all to know that I have got 6 grandchildren, and in an emotional sense, I want them to grow up in a sustainable world. That's the truth. However, I am a hotelier. I own 5 hotels. My company runs a further 30, as it involves in a lot more, so I know the practical side of this. You have a real emotional job ahead of you because you won't do it any other way. Allow me to explain. First of all, hoteliers themselves and their customers do not bring sustainability or pollution into their thinking. Very few people pick a holiday because they think they're going to a sustainable hotel. Almost nobody to date has invested because they're sustainable, and we don't even think we're polluters. That's the first problem. So we are polluters, but we don't think about it. You think of car manufacturers, steel people, mining, all the kind of companies that were mentioned before, but collectively, we have a lot of emissions. We just don't do anything about it. The second problem is you can't get to hoteliers through boards and through voting, because if there are 1 million hotels in the world, 990,000 of them aren't public. They're privately owned. And for those of you who think that's okay because Hilton and Marriott and everybody else can be an influence, there's 2 reasons why they can be less of an influence. Firstly, they don't own any of the real estate they operate. And secondly, they themselves haven't grasped this nettle sufficiently yet. And even if they did, if you add all the flags in the world together, they don't operate 10% of the world's universe of hotels. Secondly, or thirdly, or even fourthly, what's been mentioned before is that for a typical hotel, and a typical hotel is hard to find, energy consumption represents less than 3% of its turnover. So if somebody comes in and says, I can save you 10% on 3%, it's unlikely to go to the front of the board agenda, even if it should. Another problem is people don't realize that unlike almost every other industry, hotels practically last forever. I don't know what the average age of a hotel in the world is today, but it's certainly over 50 years. And most of the most valuable hotels in the world are approaching their 200th anniversary. If you think of London alone with the Ritz and the Savoy, you're over 150 years old, and getting in to correct the infrastructure of these hotels, whilst not impossible, is very challenging. It's certainly easier to build new hotels sustainably, but they are a very small proportion of the hotels in the world. I've bought and sold, I don't know, about £20 billion worth of hotels in my rather overlong career, and at no single point has sustainability ever been mentioned by buyer or seller. This is not as negative as it sounds. It's just to make everyone understand what an incredibly difficult job and what a long-term job we have to do. I would like certainly my company to help, and the truth is that most of us have no idea how. It's not something we think about, it's not something we tell about. I've only ever known one sustainable hotel group, just to contradict myself. Some of you may remember a company called Scandic, which grew up in the 90s. It was a Swedish-owned, sustainably built eco-hotel group. It wouldn't be called entirely kosher in that way in today's environment, but it was built sustainably then. We hoped it could go worldwide. I bought it at one point, and it worked very well in Scandinavia, and all the exported brand didn't work anywhere. So somebody was courageous enough to try it 20 years ago. I hope I haven't gone on too long. I could list another 100 difficulties, but I'm one, I think, of the very many hoteliers who would like to learn over time how to do this a little bit better. Thank you.
David, thanks very much. I think that's all eye-opening stuff and feedback we need to hear, because that is the challenge that faces us. All of the things that you mentioned about the attitude, the ongoing attitude of hotels in terms of their owners and their managers. I'd like to go back to a couple of the panelists with my own questions, if I can right now. Julia, as Sir David mentioned, the level of energy use in hotels is relatively small, especially when compared to the kind of industries that you showed in your presentation. Is that a barrier to being attractive to funds looking to invest in ESG projects? You're on mute, Julia. There you go.
I was still on mute, sorry. Thank you for your question. It really depends on how these funds will be structured. First of all, there are plain vanilla funds that just invest into indices, and there is nothing sustainable or not sustainable in their selection criteria. You just have to be sufficient in terms of market cap. How you get to that level of being mid cap or large cap, that's another question. And by improving your ESG characteristics is one of the ways. You're getting yourself more attractive to investors. You're getting a more stable group of investors who would be interested in you in terms of active investors. And this is how you pave your way to growing your market cap and becoming eligible for a market cap based fund. Then in terms of ESG indices, there are not so many indices that would look specifically at this sector. As I said before, we have such an index, the Developed Real Estate ESG Index, which looks at third-party assessment data. And this third-party assessment data is GRESB criteria, where they're not really assessing real estate owners on the basis of how energy intensive they are. They are assessing on the basis of how transparent they are. This is another dimension. You may be energy intensive, but you may be that for a good reason, because you're employing specific equipment like refrigerators, for example. I don't know, something that makes your type of property more energy intensive than another one. But if that's for a good reason, then you can still consider yourself sustainable if you're able to explain why it is so, and also what you're doing in your specific position to maximize the energy efficiency.
Okay.
I hope that answers the question.
Yes, thank you. That's helpful as well. And David Stevens, going back to you, when HSBC is looking at a project, what kind of things do you use to measure the credibility of the claims, if you will, the green sustainability claims being made by the project proponents? And how do you judge whether it's a green wash, as they say, or something that's appropriate?
No, thanks, Peter. Great question. I mean, I think it's a really valid point, because there are a huge number of different accreditation methodologies that are out there at the moment. I think the one that is most prevalent in the UK market is the one that's been developed through BRE, the Building Research Establishment. We've got BREEAM, which is used for new developments, and then there is the in-use methodology that they've got, which is actually I think it's about quite possibly up to about 200 questions that get asked in terms of various different inputs that go into assessing how they rate the building from a sustainability perspective. That is important for us from a benchmarking perspective when we're looking to put green financing in place, and it is specifically to avoid that point of greenwashing. What we want to avoid is sort of suddenly saying that you're converting an existing loan into a green loan. There has to be some accreditation and some standards that sit behind that, and I think the the BREEAM in use methodology is a hugely powerful tool. And as I understand, speaking to people involved in EEA and BREE themselves, that is something that gets offered to members of EEA, which I think is hugely powerful and will certainly help engage in conversations with lenders around how you could potentially access financing to improve the sustainability of a building.
Great, thank you. I can see that we've got a fair number of good questions coming up from the virtual audience. So I think at this point, I will hand over control to Ufi, who will take care of the question and answer period going forward. Ufi?
Thank you, Peter. Yes, we've had a few questions from participants, so I'd just like to share those questions, and perhaps I'll just pick a question and pick a panelist, if I may, to answer it. Julia, could we start with you in terms of transparency? There's been a question about your reference to transparency. The question relates to the tools that you at Northern Trust and other investors are actually using to assess that transparency. How are you assessing it? What are you using to actually judge the governance, the independence, the objectivity of any data that is currently provided?
With regard to climate specific, I think the best available framework is the TCFD that I already mentioned, the Task Force for Climate Related Financial Disclosures. It was headed by initially by Michael Bloomberg, the whole initiative from the Financial Stability Board, and then Mark Carney, who was at that time the chair of the Bank of England, was at the head of it. So they issued their recommendations 2.5 years ago, and the recommendations suggest that there is kind of a framework consisting of 4 specific parts that makes your company transparent with regard to climate change and your climate action. The first one is governance. Who is in charge, who is accountable, what kind of information you are using in your decision. If you're using scenario analysis, then what are these scenarios where they're taking them from? The second part is strategy. So what strategic changes you have made or considering making in terms of making your company more climate friendly? Does it really have an impact on your business strategy? Do you have to reinvent yourselves? Well, in the hospitality sector, I don't think that this is the case, but in many other sectors like oil and gas companies, as you know, these days will have to reinvent their own business and start investing into low carbon projects, low carbon energy projects. Then capital expenditures is another part of it. And finally, metrics and targets. You need to establish specific targets that you will be benchmarked against in the future. And you have to develop a set of metrics, how you will be reporting against these targets. So this is what makes you transparent with regard to climate. That's what we're discussing here. And that's a lot. That's basically the whole philosophy of a company in terms of climate change, whether you are a contributor to climate change or whether you're part of the problem or you're part of the solution.
Yes, thank you, Julia. And that leads very nicely actually on to a question for David Stevens, which is around CapEx. And the question is, David, do you actually have a hefty portfolio of hotels that are investing CapEx in ESG projects, retrofitting, for example, as well as others? And another question for you, if I may. So 2 questions for you, David. In terms of funds, Chris Brown actually asked if there's an opportunity for hotels to create funds such as the pay-as-you-save scheme, which is currently being led by schools in the United Kingdom. So a question around funds and a question around how much evidence you are seeing of investment in ESG-related CapEx.
Yeah, I mean, I think I sort of alluded to this at the start, relative to where I think not only the hotel sector is, but I think the real estate sector is in terms of that journey of transition. So I think that the short answer is no. There's not a huge number of clients that we are having those conversations with at the moment. It is a conversation that we are engaging more clients in conversations with, and actually trying to help them understand what transition means to them and what they can do. And going through that process is a bit of an iterative process. You've got to go through that to identify what the CapEx is, and then what the benefits are, and how that can be justified from a funding perspective. But right now, I think we are very much at the beginning of that journey. The clients that we've worked with to date have been right absolutely at the forefront of this. But I think there's still some way to go in terms of getting that further engagement. On the second point, it's not a fund that I've heard of at all. If I'm honest, so I'm not quite sure that I'm in a position to be able to answer that question.
Okay, well, I'll move on then, and perhaps Chris, if he's willing, after I've asked the next question to Sir David, he may, if you're willing, Chris, to explain a little more about that, just put a note up in the chat, and I'll come to you after we've spoken to Sir David. But Sir David, very candid as always. Thank you very much for that openness. We have had a couple of questions up for you. So one of the questions was, what would lead you personally in your own properties to prioritize ESG? What would it take to make that priority, given the comments you've made? And then the second question that's been posed for you, David, is when will the UK government start to tax or penalise non-sustainable hotel planning applications in order to level the playing field in terms of the cost of CapEx for development?
If I can answer the second first, I don't think the UK government will do anything for hotels. We're way down the line. First of all, everybody needs to realise that we are not a gross user of electricity, we're a net user. This has never been discussed before. 74% of the customers who come to accommodation, not just hotels, caravan parks, pubs, etc., who come overnight, turn off their usage at home when they come to us. So you can't accuse or say the industry uses 100. It loses 100 less whatever that usage is when they come on holiday. Most people don't come for 2 weeks holiday and leave the electricity and gas on at home. It's unique to our industry, but it is true. And somebody needs to put that into the equation. When you put that in the equation, I think hotels are going to very far down a list of any government action. And I think it's back to appealing to hearts and minds. To answer the first part, it's a little unfair because the people in my industry have had an industry shut for 12 months with no income and face at least 3 years before recovery. So I doubt we'll be able to invest in saving power. We're more interested in giving jobs and serving our customers at the moment. But that sounds terribly negative. This isn't a subject that's going to go away. The hotels have been around, well, certainly for 2,000 years, when Mary was outbooked from the inn, and changes aren't going to take 2,000 years. But if we start now, there will be a time when we finish. So very small things. This is an industry where, as far as energy is concerned, if we can start small, it will grow big. If we try and attack the industry in any way, not that anybody has done so or is trying to do so, we'll just meet a very sustainable brick wall.
I absolutely agree with you in terms of legislation perhaps being a little way off for our industry. But just, if I may go back to David Stevens. David, in a previous chat, we talked about brown discounts and green premiums. Now, there have been many hoteliers that I've spoken to who've said, well, there isn't really any evidence at the moment of green premiums for our industry. And certainly we're not seeing a demand from customers that we can translate into higher room rates, for example. So, where is the business case for investment? So could you share with us your thoughts on that, and also talk to us a little bit more about, when, if at all, can we really expect these brown discounts to have an impact on our asset values?
I mean, I think in some ways, this does tie back into, you know, I guess a bit of a regulatory point, because I think there will be increased regulation in terms of, you know, how the real estate sector, and I'm sort of putting the hotel industry within that, in terms of buildings that are within the real estate sector, are measured from an energy efficiency perspective, and there are ratings that people have to achieve. And I think the reality of when that sort of brown discount will come in, and it's sort of, again, I alluded to it earlier, you know, CBRE are telling us that when people are looking to make investments in buildings, they are looking forward to see what the sustainable, what investment is required from a sustainability perspective to meet future regulations of the standards that building needs to operate at. And if that is then being fed in terms of a discount on price, then I think that's where we'll start to see a brown discount relative to a green premium. I think over time, green is going to become more of the norm, but those buildings that aren't getting to the required standard, you will start seeing a reduction in value.
Thank you, David. I can see that Chris has just come back into the chat with a little more on the programme related to schools that he mentioned. So I'm turning to Lucy now, my colleague. I don't know if she can bring Chris into the chat just to explain a little more about this programme.
Yep, here I am.
Wonderful, welcome, Chris.
Okay, so yeah, the schools can tap into a government fund which is for improving public sector building energy efficiency, but basically they get the funds up front and they pay as they save. Now, obviously, the government's never going to do that for hotels or for anyone in the private sector, and least of all now. But there's just really a question as to whether there might conceivably be a fund, a privately backed fund, that might offer capital upfront for a payback on the savings made, and that, you know, that could potentially tip the balance for a hotel to cover its roof with solar panels, for example.
Who would like to tackle that? Julia, would you like to tackle that, and then perhaps David?
Well, unfortunately, I have very little to say here. I know that, you know, there are some programs supporting residential homes solar panel installation, but I'm not sure that there are, well, at least I'm not familiar with funds that would exist to provide upfront financing for such retrofit in the hospitality sector. I wish I could, I wish I knew more on this.
What about you, David? I mean, perhaps, for example, arguably, a green bond is some form of, you know, a means to raise capital. And we have actually seen a number of hotel companies and REITs who have raised green bonds.
Yeah, no, there have been. I'm sort of struggling with the underlying investment case that might fit behind that from a funding perspective. Yeah, it's not something that I've come across, if I'm honest, Ufi. So I'm in a similar place to Julia. I'm not quite sure how the economic case for that would actually sort of mount up into something that you could sort of certainly access capital markets through. So yeah, I think it would have to be more of a sort of a private initiative from maybe supported by government, I think.
Okay, well, let's move to Peter. Peter, we have a question that you are probably best suited to answer. And the question relates to when this does become a critical issue for the industry. Might it lead to a change in the fundamental hotel business model? And may it lead to the big brands, the big 5 brands, for example, buying back assets again?
Wow. I have a hard time imagining hotel companies being interested in buying back assets. I'd be interested in what Sir David thinks of that as a possibility. I do think that the hotel companies are going to be put under more and more pressure to be able to show their green credentials, and they are going to be looking for credibility with this, because it would be easy to spend a lot of time, energy, and money on things that don't actually get them their street cred when it comes to sustainability. I also believe that, as we saw from Julia and her involvement with funds, that more and more money is going to be looking at the credibility of green claims by companies. And that will help push reluctant industries and companies towards the direction they should be going in. No, I think Sir David is right. It is going to be tough. The saving grace for me is that the younger generation sees this as being a much higher priority, I think, than those of us of the older generations. And they are more willing to, if you will, trade off every last ounce of profit in order to have sustainable businesses and an ongoing livable environment. So it's going to be tough, but I think there are enough things going in the right direction that reluctant hoteliers are going to have to be dragged along eventually. And one of the things, of course, that we're trying to do with the EEA is to make that easier for them to do earlier on in the process, rather than wait for some insensitive bringer of various kinds of requirements that we have to meet as real estate companies. And then we're going to be there pointing at each other saying, well, he's the owner, oh no, but he's the manager, but it's the brand that sets all the things we have to do in the hotel. We have to get in advance of all that. We have to get ourselves organized ahead of that and show how we can take steps that are credible, that have sustainability, that are benchmarkable, so we can see the progress and we can make credible statements about how our hotels and how our industry is becoming more green and more sustainable.
Well, I'm unless anyone else has any questions that they would like to put up, I think that brings us to the end of the questions, Peter. So I will hand back to you for final thoughts from the panel and for your
well, I just basically went through my final.
If I can just add my thanks to it, just say thank you to everyone who's participated, and thank you very much to the panelists.
Yes, indeed. I find that I've just basically gone through my closing speech there, so that save you all a bit more agony. To me, it has been a very fascinating and useful group, as I hope you will all agree. We've heard a lot about the challenges that we face as an industry, the fractured nature of our industry, the fact that we have relatively low levels of energy use. This is all very true. But I also believe that we cannot afford to do nothing, that we have to take whatever steps we can. And we at the EEA are trying to put together a method to do that through offering best practices, through offering various ways to go green when it comes to sustainable energy and electricity that will actually bring increase in profitability for hotels. And working with BREEAM, which is the most important of the real estate measuring companies out there, we are putting together a hotel-specific form of measuring and benchmarking hotels' sustainable levels and their journey on the voyage towards carbon neutrality. With those sort of things in place, we believe hotels will be able to sign up and we'll be able to see how they are moving on this journey towards zero carbon footprint and how they are comparing to other hotels. They will, in my belief, this will be repaid not only from the emotional standpoint in helping the environment, but in terms of access to funds, as we've been hearing from Julia and from David, and in terms of being more competitive in a marketplace where how green you are is going to become more and more important to our guests. So with that, I would like to encourage any of you who have not yet joined the EEA to do so. We would very much like to have you on board and part of our group. You can do that by going online. You can contact at eea.international, our website. You can, of course, also contact Ufi or myself directly. It's Ufi at EEA International or Peter at EEA International. With that, I'd like to thank again all of the panelists for all their help and all of the attendees for taking the time, and wish you all a very good evening. Thanks very much.
Thank you, Peter.
Thank you. Bye-bye.
Bye-bye, everyone.
Thank you.
Thanks, Peter.